Investors Chronicle.
Hello and welcome back to the IC interviews. I'm Mary McDougall, and joining me today we have two guests, both calling in from Singapore, Adrian Lim and Pruksa Iamthongthong, co-managers of Asia Dragon Investment Trust. The trust is the second largest investment trust in the Association of Investment Companies Asia Pacific sector, with 794 million in assets at the time of recording. The managers have comfortably outperformed their benchmark, the MSCI Asia Pacific Japan Index, over the past 5 years by searching for high-quality companies with good cash flows and healthy balance sheets. Adrian, Pruksa, thank you for joining me. Before we jump into your investment approach and talking about the fund, inflation is the big question on everyone's mind at the moment and in the financial media. In your latest market commentary, you acknowledge that inflation is emerging as a cause for concern amid the boom in commodity prices, but you say that you believe inflationary pressures will be temporary. Please, can you talk us through your thoughts on the topic for both China and the wider Asia region?
I mean, if we look at China today, inflation seems to be relatively under control. But I think what is catching investors' mind is the spike in PPI, the Producers' Price Index that is, I think, leading the way. And the question is, how much of this will actually translate into higher consumer prices? So far, we are not seeing this appearing yet, but I think it's something that we are watching relatively closely. I mean, when we look at the reasons behind the rise in PPI in China, then a large part of it seems to be driven by higher imported raw material prices. So we are seeing prices of, for example, iron ore is having a very strong increase, partially driven by the strength of demand as the global economy opens. Part of that get transferred into China as iron ore prices are more global in nature. Part of this is also due to the supply issue where in many parts of mining communities, they are in emerging countries, and that's where we are still facing with COVID-related issues, and therefore supply was also somewhat disrupted. So we are in this sort of like an imbalanced type of a period at the moment, and that's why we are seeing this spike up in price. So the Chinese government is watching this closely, whether, how much of this PPI is going to translate into CPI. But I think the other part of the equation that we have to think about is also on the food costs, which is a large part of CPI as well. And so far, that seems to be relatively under control as well. After, over the past 2 years, we have seen quite an increase in pork prices in China, for example. So I think there are many driving forces in this. And certainly when inflation should come back as economy opens up, as we have seen with, the global economy as well in the US, where we are seeing a very strong stimulus program coming through. Inflation can be a risk, but so far, if you look at the stimulus program back in China, they have been also on a relatively disciplined manner this year. So I would say it's a concern, but it seems manageable so far.
Thank you. Adrian, do you think it's a concern outside of China in the Asia region?
Yeah. I mean, the things that Pruksa talked about, the commodity prices as well as the opening up of the demand cycle following a terrible 2020 is prevalent not just in China but across the region as well. There will be some local adjustments for each of the countries with the logistic constraints as well as the supply constraints. But by and large, that is something that is expected given that there will be quite a recovery shock when that comes through. The pace of this would be quite dependent on how COVID is brought under control as well. And, vaccination programs are being rolled out at different paces in different geographies. And that's something that will have an impact on how fast or whether inflation shows up in a meaningful way or not.
Absolutely. In terms of the opening up of the economies, you're in Singapore, you're under a fresh lockdown at the moment. How are the vaccine programs across Asia coming out, and how do you see the opening of the economies over the next year?
Well, across the region, there has been a variety of vaccination successes and failures or delays. And actually, the range of the reaction has been quite varied as well. So in smaller economies, in smaller markets like Singapore, which is reasonably manageable and is well administered, vaccination rates are pretty high by Asian standards. That's in the 20s for full vaccination. Not quite there as what you would have in certain parts of the Western world, but reasonably moving in the right direction and accelerating as news of supplies have been positive over the last 1 or 2 weeks in the different countries as well. And then when you compare that just within Southeast Asia, for example, there'll be other markets or countries where vaccination rates have not been quite so fast. And in the low single digits would be places like Philippines and Thailand. But those are also being moved in the right direction as well. But they can come in fits and starts given the natural logistical challenges and physical challenges of getting vaccines distributed, stored, and then vaccinated across countries which are quite spread out and which do not have the same level of education or population density.
Tying that to your fund and your investment approach, all these countries opening up at different speeds, where are you seeing the best value within the portfolio? What geographies and sectors? Pruksa, maybe you'd like to start.
Yeah, I can start with that. And I think, as vaccinations rates increase, we are likely to see economic activity resumes and consumption and, the spending that people have been holding back because they are hoarded up at home are coming out to the forefront as well. So with that, if you think about the sectors that could be well positioned for this, it would be firstly the services sector. So services sector, for example, within China, where we are already starting to see this happening currently, as China is the first in and first out of the COVID situation. We are seeing things like domestic tourism, things that are related to consumption or premiumization of consumption, and the companies that are behind providing those services, they are actually seeing good numbers coming through in terms of their earnings. And I think we are continuing to see that opening up on the domestic theme within China. So within the portfolio, we do have companies like China Tourism, for example. And what they have as one of their business is they have huge duty-free stores on this holiday island in China. It's a Hainan island, so very sunny, very good weather. And as the economy opens up, domestic tourism, that people do go there to take their holidays. At the same time, they go there to spend on duty-free goods, where in the past they might travel to Korea and Japan to buy some of these goods, for example. But now you can actually buy them within China itself. And there has been a change in the amount that you can buy. So the quota has been lifted and the type of goods that you can buy as well. So you are able to buy more than cosmetics, which has been, I think, one of the key purchases in the past. So that has been one of the beneficiary that we saw in terms of resumption of services. Other areas that we are seeing would be places where it's more of domestic tourism destination. So Sans China, for example, is one that could start to see more interprovincial traveling coming through as well. That could be one that we are starting to see some of the premium mass consumption coming through into Macau as people look to have more leisure travel. And the other area that could be quite interesting is actually an insurance company called AIA. So AIA, what they sell is premium life insurance protection business. They do have a large presence in China, but they have also a very sizable presence in Hong Kong. And in the past, their Hong Kong book, the growth is actually driven by Chinese travelers crossing over to Hong Kong to buy some of these life insurance policies because they are priced more comprehensively. And that remains one of the things that we think will continue to come back as China reopens their border with neighboring countries. So yeah, plenty of opportunities.
Yeah, that sounds exciting. How are you feeling just generally across the fund? How are you feeling about valuation levels? Because India's had a strong stock market recently, despite being possibly one of the worst affected countries by the pandemic. China's had a very strong market last year, which has tailed off a bit in the last few months. Adrian, perhaps you could talk through different parts of the funds and how you feel about valuations.
Yeah, I mean, as you correctly pointed out, India, from a top-down perspective, based on PE multiple averages, is not cheap. So that's not a place where you would typically see value from simple valuation methodologies. But there are things there that we like, that we think have proven resilient over this period of time. And actually, it's very difficult to conclude on valuations by countries or by markets at this point in time. There is a lot of built-in uncertainty with respect to the recovery in 2021 or 2022, with the opening of borders, with COVID vaccination progress, and with the rising chance of inflation as well. So it is across the region, there are pockets of opportunities in recovery stories that we think prove themselves to be reasonably priced if recovery comes in the next 12, 18 months. But, that's a very difficult call to make. We are seeing things that look superficially cheap on 12 and 18-month forecasts going out, but currently, because of the difficult period that they have just come out of, have very little to show in terms of earnings and cash flows for it. So that's something that will be a challenge. With respect to India itself, it has been a beneficiary of being relatively late in the recovery, and then enjoying a relatively strong run of liquidity, primarily driven by domestic and then at times driven by foreign capital as well. And that has carried forward this year. We are quite cautious that although the fund and the trust has an overweight position and it's full of stocks that we think are very good franchise within the Indian market, we are quite prudent and we are quite cautious about the exact pace of recovery though. So we like things like HDFC, which has a very strong franchise in the Indian mortgage market across India, not just in one or two states. We like the management team there. We like the way they prudently manage their balance sheet. But we do need to keep an eye on these things. And valuations at certain places and certain sectors are priced for a perfect recovery, something that we think should be treated with caution.
You've mentioned a few financials. I was looking through your holdings earlier, and it does look like there are a number of banks. And I think it's quite interesting how the sector's evolving. So there's a lot of talk about the future of money at the moment. And you have China cracking down on cryptocurrencies as well as testing its own digital yuan. Do central bank digital currencies pose as a threat to the value of banks? And how do you see this evolving in Asia?
Yeah, I mean, if we look at the long-term development of central bank currency, the digital currency in China, it's quite interesting that they began to look into this as early as 2014. And I think over the course of the pandemic situation last year, they have actually begun doing some pilot testing in cities like Shenzhen, Suzhou, for example, where what happened was that they give you hongbao. Hongbao is like a red packet in China where basically you give digital money in red packets. Most of the time you give it during Chinese New Year, but this time I think they are just testing out the digital currency through their distribution channel. And if you look at the key players as to how this digital yuan is working in China, one of the most distinctive is that the traditional players are actually part of this whole supply chain. So you have the central bank, the PBOC issuing the digital currency. They then distribute it to the commercial banks in China, and those would be the large state-owned banks. And the commercial banks in China then work with guys like WePay or Alipay, for example, to come up with certain app, and they are all partners in trying to distribute this for use to test the use cases. And usually the link between them is the QR code, where you can open the app up, use the QR code, and you can scan it at the end consumption place, whether in certain retail outlets, for example. So that's the whole distribution. And from that, you can see that the intention of the central government so far is to actually digitalize the physical money in circulation. So, and the reason behind that is that, physical money, whether you think about the banks and coins, is a bit, it's difficult to keep. It takes money to actually print them. And I think more importantly, it's difficult to trace as to where this physical is being used, for example. But if you digitalize that, that solves the cost side of things, but it also improves the traceability side of things, which I think as time goes by, that is going to become very, very important information for the Chinese government as a whole as well. So far, they are coexisting with the likes of WePay and Alipay. But then what this means is that you are very likely to see increased competition for the two dominant payment systems that are in China. And it is really up to the consumers to actually choose which one serves them better. So I think it goes back to us having the confidence in, whether the payment systems guys like Alipay or WePay are able to continue to innovate the ecosystem to bring the most convenient way to use the payment system for consumers. And usually in China, as the way that we have seen the model evolve, payment system is just the beginning. After you have the payment system, you then use them to do other things like use the spare money to make certain investment, use the spare money to actually buy insurance, etc. So it's not just a payment system. Is what I'm trying to get at, and there's a lot of innovation involved, and I think we are going to head that way in terms of the development of the future payments industry.
It's fascinating. It's a really interesting area. And just sort of moving on from, you mentioned Alipay and Alibaba as a big holding in your fund. How are the antitrust proceedings developing in China? So Beijing's trying to curb their dominance of Alibaba in particular. How do you think this will play out? Is it posing as a threat?
I think it is playing out at the moment, but I think what we should be aware of is to perhaps take a step back and look at I think the broader context of why this is happening in the first place. And I think anti-monopoly is just one piece of the puzzle. If we take a step back and look at what the Chinese government has been trying to do over the last 2 to 3 years, we can think of them as the Chinese government overall is trying to sort of like strengthen their house. So if you think China is a very big house, is trying to strengthen their house, strengthen their foundation to be able to withstand, a lot more stormy weather, which I think over the last 18 months, China has gone through a fair bit of that stormy weather. I think we would all agree on that as well. And therefore, over the last 2 to 3 years, what we have seen is that, China has begun with the supply side reform that was painful in cutting some of the overcapacity industries. They have moved on to deleverage the economy to a certain extent. They have moved on then to basically try to control the rise of shadow banking and bring down that proportion. And then COVID hits. So when COVID hits, a lot of these reforms have actually been pushed to the back burner for a while because you have to deal with the COVID situation. And now this year, when that is more relatively under control, we start to see this strengthening the house coming back into the forefront in terms of the Chinese government agenda. And I think it's no surprise given that the digital economy in China is such an important pillar of the house that China would need to find a way to evolve along with the increasing regulatory challenges. And the thing is, this is not only unique to China. I think globally, all the regulators are finding ways to evolve their regulation as well to be able to govern the risks associated with the growth of digital economy and the big tech companies a lot better. So I think it's a question of regulation catching up in this space. And I think what the Chinese government ultimately wants to do is not to kill off the innovation. I think they do realize that innovation is very, very important in this space. And it is also not out to nationalize the industry as well, because they know that in this space, to be innovative, you actually need to let it to be run in the hands of the private players, but then within a certain framework that they are trying to set in place so that they can control the risks. And this is happening across different sectors where China is about controlling the risks, making sure that if growth is happening too fast, you try to rein things a bit back in, and then you try to make sure that the foundations are better suited for that level of growth. And I think this is what is happening today within the internet sector in China. Alibaba is the first one. It is also the most widely acclaimed one as well, but I think this is happening across the whole industry.
Yeah, it looks like the regulator's been a bit softer on Tencent. Do you think Tencent will be next?
Well, actually, Tencent has gone through that level of scrutiny before as well. I think any company in China that has a very strong market position within the sectors they operate in, and in this case, Tencent would be very strong in gaming, among other things that they have evolved from. They have gone through that level of scrutiny as well. We saw that a couple of years back, for example, the Chinese government was very concerned with the impact of gaming on society and held back or slowed down the approval pace of new games for the Tencent group as well. So things can come in the form of penalties or fees, or it can come in the form of additional levels of approvals or additional lines being drawn about how businesses can operate. I think given the scale and the strength and the incumbency of companies like Tencent and Baba, even if they were if they were in any other country, they would be going through the same levels of scrutiny as well. I think governments are always mindful of monopolistic tendencies, and in fast dynamic markets like this one, where there has been a lot of innovation over the last 10 years, they would especially be mindful of that.
And Pruksa, you mentioned the shadow banking sector in your previous response. How is the expansion of credit in China something that you worry about?
Yes, it is. But I think we are not the only one worried about it. The government is also worried about it, and that's certainly good news, because that means that they are aware of the issue, and therefore they have begun working on the issue as well through over the last 2-3 years, deleveraging that part that I've been talking about as well. So I think the discipline is there in terms of trying to bring down the leverage. The discipline is also trying to be more disciplined with regard to the stimulus measures. If you compare the stimulus measures that China has put through over the course of the last 12 months versus elsewhere around the world, I would say that they are relatively restrained. And I think the concern about leverage has some part to play with regard to how much they were willing to spend to stimulate the economy. I think one particular area where within the broader leverage where it's more concerning is the real estate sector in China. And that's where we also see that regulations by the government have been a lot more stringent, which actually started last year as well, where the government has not only put through restrictions on property developers. So basically they have issued measures, what you call 3 red lines. But essentially what that means is that if you have a certain financial leverage above certain financial ratio, you will not be able to get more access from the banking system to fund your growth. So that's controlling leverage on the developers front. You also have the government controlling leverage on the consumers front, where basically the banking sector would not be able to make more loans if they have exceeded a certain quota of their mortgages over a certain period of time. So you will see that the Chinese government does pay a lot of attention to leverage, and within that, the leverage in the real estate sector, given how it is very much tied to consumers as well, and is a large part of the economy as well. That's something that they pay a lot of attention about, and that's something that we do look at a lot as well.
Looking at leverage in a different part of the market, Adrian, so the Chinese stock market, there's reports about high levels of margin trading. I read on Reuters last week that China's margin trading balance on the Shanghai and Shenzhen stock exchanges has reached its highest level since 2015. Are you seeing froth in the market, and does sort of frenzied retail trading, is that something that worries you?
Yeah, I think when you see these levels of excitement or frenzy, I think you're always worried. But this also, China is not unique in this sense. Quite a few of the markets that we've had in the region, the strong performance in COVID recovery has come from retail capital. So that's something that we need to bear in mind and watch, and make sure that what we do when we pick stock, when we trade, is we need to be very mindful of the underlying companies and what they're currently seeing on the ground. And if we see that a rally or commensurated or valuations are far beyond what we think is a prudent position to be in, we tend to pare back instead of like fanning the flames of some of these rallies. So it's something that we are mindful of.
I think within the China onshore market, it has been a retail-driven market, and I think it has also been a very volatile market with margin financing. So this is not something that's new to the nature of the market at all, and that's the risk that we have to always be aware about. But I think this is also one of the reasons why where it creates a lot more mispricing opportunities for institutional investors like us to be able to take advantage of some of this sell-off in the market to buy into the stocks that we like, that we think are fundamentally sound. So we actually view this as an opportunity, and for us, it's going back to each stock level and making sure that valuations don't look too elevated versus their growth expectations.
And in terms of your investment process, looking at your fact sheet, the country allocation is quite similar to your benchmark index. Is this by design, or is this just where you're seeing the best opportunities?
This is where we're seeing the best opportunities. Most when we look at things from a top-down perspective, of course, as well. But the primary driver is really looking and comparing stocks between their peer group, stocks between their peer group within the region, stocks between their countries, and really coming to that kind of granular decision making. You would have found that with our stock picking process focused very much on the quality of identifying Asian leaders. They are good at what they do, not just domestically but internationally as well, to some extent. What we have done is over the last 2-3 years, you've seen a gradual shift towards North Asia. So if you compare Dragon's portfolio exposure, you would see that in China, in Korea, in Taiwan as well, there's been a greater shift in increasing the weights. And part of it is, a big part of it is very much driven by company-specific performance, where we've seen resilient P&L performance over this difficult 2-3 years, where you have seen very steady investment, and where you've seen business models that have proven to be successful in the new economy space as well as resilient in the old economy space as well. And that's been driving the portfolio composition or profile on a geographic perspective.
And perhaps I would like to add that, even though we might look like we are close to China from a benchmark perspective, the composition is actually quite different as well, where within that we are actually overweight to the China onshore. So domestic China Asia, we are overweight to that, and we are actually underweight China offshore names. And apart from China, we do have a very exciting market positioning in Vietnam, which is off benchmark position.
Yeah, well, we'll come back to Vietnam, but just can you just tell us the difference between the A-share market and the offshore, just in case any of our listeners aren't aware of that?
Yeah, sure. I mean, if you look at the A-share market, we find the A-share market, the reason why we are overweight there is because we find the A-share market to be a very exciting one for stock pickers. So I've talked about the inherent volatility driven by the retail trading that allow us to, pick the stocks that we like and more mispricing opportunities. But in terms of the type of companies as well, the A-share market offers us a more interesting mix of consumption. So consumer names within China, very strong brand names. So companies that are bigger names in our portfolio, like China Tourism is an A-share name, for example. So some of these names are just not available on the offshore market or in the H-share market. In the H-share market, it tends to be more of a mixture of, say, old economy stocks. So you have the real estate companies, you have some of the very large state-owned banks, and then you have the internet names, which we do like some of them and we don't like some of them, and that's why you will see that the positioning is quite different.
And Adrian, Vietnam, can you tell us about some of your favourite Vietnam holdings and why you're keen on the region?
Well, Vietnam's coming off from a very low base, and because of its slightly different development of its markets and economy and its marketplace and capital markets, there is a very steady opportunity to reform and catch up with the rest of the region. So we like it based on where it's at and the direction it's pointed to, which is to increase the efficiency and effectiveness of its capital markets. And among them, we've got quite what we think is quite a nice balance of portfolios. We've got primary one is Techcombank, which we like. We think it's a medium-sized player within the Vietnam market, but has proven to be very resilient, focused on doing the right things, even during the difficult 2020. We know that the operating environment was difficult at that point in time, and yet it managed to grow profitably while maintaining steady, healthy margins without compromising the asset quality of its loan book. So we have the biggest position there. Then we supplement that a little bit with Milk and Mobile World. So we think that these are three opportunities that give us a nice balance. They are off benchmark, so they add a little bit of spice to an opportunity to the trust. But we want to be sure that we are quite prudent as well. So this collectively makes up about 2.5% of the trust.
And we've talked a bit about the areas that you like and that you've been adding to, but can you tell us what companies you've been selling most recently?
Well, actually, it's been a very interesting 5 quarters. Since I tend to look at it at 5 quarters because that's when the COVID shocks hit the markets. And if you look at our list of stocks, actually we've been doing quite a bit of name change, name trading in the last 1.5 years or so. So typically in every year we buy about 8 to 10 names. We sell about 8 to 10 names, and that's what we've been doing for the last 3-4 years. But the last 1.5 years or so, we added about 20 to 30 names, and we sold about 20 to 30 names as well. So there's been a lot more name change turnover in the portfolio. And one of the reasons for that is the amount of volatility we've had in the market. And sometimes you don't get to buy as much as you want before you start selling again because there's so much price volatility in the market that you can't justify or feel comfortable with some of the strong rallies that we've had. And the opportunities are all over actually. You couldn't say that we were very big on China at this point in time. We were already big on China pre-COVID, and it gave us an opportunity to change the asset mix and exposure mix within China. But actually our profile from a geographic perspective has not evolved very much during this time. But within each of these sectoral baskets, we have the opportunity to buy and sell some of the positions here. I think of the just the notable ones, the notable initiations over the last 15-18 months would be Alibaba as one of the holdings that we have added, and InfoEdge is quite interesting. And these are two stocks that are quite interesting because they feed very much into the e-commerce, into the online migration that's been triggered and catalyzed by the COVID shutdowns in China. These two stocks are Chinese and Indian, but that's happened across the region. So that's quite an interesting play for the portfolio. We've also been reducing things in certain markets where they have slightly older economy connotations, but because the operating environment has also been tough, and we've been seeing a delay or postponement of the pace of recovery. So some of our real estate stocks, for example, we have also been paring back and reducing. So things like city developments in Singapore, as well as stocks like Keppel and Central Patana, which we think are going through a difficult cyclical time where recovery will be stretched out. Those are some things that we take some profit off and exited as well. So all in all, a lot of trading opportunities, a lot of initiation and exit opportunities, but very difficult to call a trend given the volatility of what we've seen in the market.
Absolutely. I was going to ask if you've maybe been pivoting back into the more cyclical stocks as the economy opens, but it sounds like that's not the case.
There has been a slight adjustment there. So as you know, quite a lot of the we saw quite a lot of resilience and excitement in the less cyclical stocks, the more technology or the online migration, evolution type themes and ideas. So that had served us well in the second half of last year. But because of the what we think of the added positive sentiment coming up from vaccination announcements and programs and the change of guard at the White House, there has been a greater positive sentiment within the marketplace that had allowed some of the cyclical stocks to gain traction as well. So we are looking at some of these opportunities and adjusting for them at the side, but they are not meaningful adjustments. The trust needs to be balanced for all kinds of opportunities, and we can't pivot hard the other way because some of the stocks that are being rotated out continue to deliver some very good numbers in these few quarters. So we like the balanced approach.
Sounds reassuring. People always say how difficult timing the market is. It looks like environmental, social and governance factors play an important part in your investment process. Pruksa, could you tell us how you assess these factors and what sort of standards you expect from companies, and maybe how it compares in Asia to in the West?
I think we do take ESG factor risks very seriously, and that forms a very much the key pillar of our overall quality assessment of the company, because that drives the longer term sustainability of their operations as well. And I think what we try to do is we take things down to the company level, so everything is bottom up. When we think about the issues of the ESG, we bring it down to the company level and we assess it like the way that we assess, the business model of a certain company. We then rate how this ESG, how the company is dealing with their material ESG risks that are pertinent to the company, then also is pertinent to their sector, for example. And that's really important because there's no one size fit all. You got to be able to analyze the relevant risk for the relevant company that would be driving the material difference. So for every single company, we would have our own internal view of its ESG capability. We would then also have an understanding of, what are the key ESG engagement areas that we would like to achieve with the company. And then when we go and meet with management, we then drive some of this agenda and ask perhaps hopefully a thought-provoking questions to the management team as to, how are you dealing with all this? And then with that, we come up to have our assessment of our overall ESG rating of the company. What we then do with this is that we then compare to what external rating agencies think about this company in itself, and then we see where the difference lies. And I think most of the time when we find with the companies that we own, at least in Asia, is that they are doing the right things. They are very aware of the risks. And I would say the understanding of this topic has increased very much over the last 3 to 5 years. Before this, we were quite far behind. But I think the understanding of this topic has increased very much. But I think the disclosure of what they are doing in particular to this topic is actually quite poor in Asia. And that's where the gap lies between Asian companies and Western companies that I think are more well-equipped and get asked a lot by their respective investors with regard to the disclosure. So I think what we are trying to do quite hard is to make sure we understand the risks of the ESG. We make sure that the external rating agencies do understand what the company is trying to do as well and get them to improve the disclosure. And hopefully that will allow us to benefit from some of the positive changes that goes on at the company level.
How much engagement do you have with companies on the subject? Are they quite open? Like even if the disclosure is not high, how much access do you have to management to discuss these things? And maybe that would give you an advantage as an active manager, as this is a fast-growing area.
I think the conversations have been getting easier because we have been having this conversation for a very long time within Asia for many, many years. And, our name works in such a way that because we are long-term investors, over time, the management of these companies trust us to have these conversations and also trust us that we are genuinely aligned with them in terms of the long-term interest of the company. We are just not out there to ask these questions, and then when there's something happens, then we sell out the company and make a quick buck out of it. We are there as a long-term investors. So having that trust that we have been building with management definitely helps with the engagements that we do with the company. And generally, we meet our companies at least twice a year. Now, given the pandemic, it's more of a virtual meeting. We can't do a physical thing at the moment, but hopefully that will improve as the pandemic eases. But the engagement that we do can happen during the two company meetings at least, or if there's a more pressing issue, we can have meetings along the way as well, and there'll be email communications. I think generally companies in Asia are very receptive. They know this is important, and I think most of the time the issue has been they don't know how to do it, and therefore our role as a pan-Asian base with global presence, and our European counterparts do know this a lot better as well. We then share the best practices that we have seen from other parts of the region to the companies and sort of like guide them as to how they can do it to improve their disclosures, etc. So you will see that there is a strong alignment of interest, and that's why I think the conversations have become easier.
And on the ESG theme, Adrian, what do you think of the environmental risk for the chip makers? So Taiwan is suffering one of its worst droughts in decades, and Samsung's chip revenues fell, I believe, because of the freak winter storm in Texas. What do you think of the environmental risk for the chip makers?
I think water has been highlighted as a concern for chip makers for some time. What we do is that we work very closely with all the resources that we have within our teams. We have a team of over 40 across the region, and then we've got ESG specialists as well. And what we do is that ESG specialists help us highlight themes that we should be aware of, or we can lobby for or agitate for, and then we work together collectively to highlight things. Water has been something that Samsung and TSMC has sought out for some time, and actually they've had commitments to improving the quality and making sure that they are reasonably well positioned and are aware and control that risk, and that's what they do. But the drought is a difficult one, and I think that's one of the operational risks that you have of an operation of this size, and it's something that they need to continue to focus on. But we are convinced that Samsung and TSMC are among the best, if not the best, in this, and given their awareness and their know-how, they will be able to manage this risk within a reasonable framework.
And the other risk for TSMC, I think, is the political risk. What do you think would happen? What would be the outlook for the company if relations between Taiwan and China got severely worse?
Shall I leave that to you too?
Pruksa?
Yeah, I mean that's a difficult one, but I think we have to understand the context that China actually imports a very large amount of semiconductor over the last few years. The amount is very, very sizable. I would put it up there together with their oil imports. So it's not just that TSMC is dependent on China. I think China is also dependent on the importing of semiconductor chips, where TSMC is perhaps the world's leader in terms of manufacturing the advanced part of the semiconductor chips. So it is a delicate balance on the political interests and the economic interests there, as semiconductor chips do power a lot of the digital economy that we have spent time to talk about. They are the building blocks as well. And if China wants to continue to invest in building up their 5G infrastructure, in building up, the autonomous vehicle, etc., in building up the artificial intelligence capabilities, you will all need semiconductor chips. So in the meantime, I think what we have seen is that China has actually put it part of their 14th five-year plan. And this is a continuing theme from the 13th five-year plan as well, that they want to be more self-sufficient in semiconductor chips. And I suppose that will continue to be a very much longer term structural push that China will try to make and will continue to invest. At the moment, I think for the next 3 to 5 years, China will continue to invest there, but it will continue to be very reliant on the global supply chain with regard to the advanced part of the semiconductor chips. And I mean, if we look at TSMC as well, China is a big market for them. And in terms of their production base, you also see that the most advanced part is in Taiwan. They are, I think, as a result of the trade war and I think various countries coming to realize the security of the semiconductor supply chain, we are seeing more investment coming through in the US as well. So that's the next part that is coming up. And I think over the last few months, we are hearing news flow of, more investments in Japan, more investment in Europe. I mean, those are not as concrete as the announcement that we heard in the US, but that is coming through. And TSMC does have a semiconductor chip factory in China, but they are perhaps not on the most advanced side of the spectrum.
And what's your outlook for Samsung? That's a big holding.
We think Samsung is very well positioned for growth, and Samsung, one of the Samsung main business in semiconductor chip, they do what you call a memory chip, and that would be the chips that you use within data centers, for example, as well. So this is one sector that is going through what you call a cyclical recovery at the moment. And therefore, from the point of view, as more data centers get built up around the world, you start to see more demand from that for memory chips. And that is going to be a long-term structural trend. And Samsung is the global market leader within this space. So you are seeing that strong longer-term structural trend coupled by the nearer-term cyclical trend for Samsung within that business. We are hearing more movements as well. And this might be a smaller part of Samsung, but Samsung does have a pretty decent 5G infrastructure business. And as with some of the global reshuffling that happened given the US and China trade war, this creates more business opportunities for Samsung to be able to increase their market share in this space. So this is another increasing opportunity. And I think other parts of their business, they are also in consumer electronics like mobile phones, for example. Again, some of that, they will be gaining some market share as a result of the US-China trade war shakeup. That is a growing opportunity. But I think the most attractive part is that when you put all this together, you have a company that is strong in various businesses and is attractively priced, and they have very strong free cash flows as well. So I think the financials aspect of Samsung is also something that differentiates itself from the rest of the US technology peer group, which tends to be on the expensive end. Samsung is on the relatively cheaper spectrum.
Yeah, that's interesting. Thank you. And I'm afraid we're getting close to time, but I just want to ask a couple of questions about the fund itself. The gearing levels, 8%, had a look earlier. How does this compare with historic levels? Adrian, is it reflective of a rich opportunity set?
It's slightly on the low side for historical. The way we look at gearing is that there's a certain level of structural gearing that we want to take to give the portfolio some modest boost in terms of returns, because over the long term we expect the markets to do reasonably well, and then we expect the trust to outperform that over the long term as well. So 6 to 8% is broadly what we would have, what I would call us having a layer of structured growth. And then at certain points in times where there are weak cycles, we would like, if possible, to top up gearing a little bit more to 10 to 12, maybe 15%. Last year, there was a point in time in Q1, Q2, when with the COVID shutdowns, that there was an opportunity, but that dip didn't last long, and therefore we've actually, with the strength in the markets at this point in time, we're quite comfortable with an 8% leverage effect on the trust. So there are opportunities, but as a house, we don't tend to be really aggressive on gearing levels as well. So I think that if you do get a dip, a strong dip that's not fundamentally grounded, we would be gearing up the portfolio. But at this point in time, with the way markets are, with a lot of positivism, at least in the capital markets, for a recovery, I think this is at the adequate level of gearing.
And the discount has tightened a bit from sort of average of the last few years, but it's still wider than some of your peers, despite good performance recently. Why do you think this is?
Oh, that's...
Is that a fair question?
Well, we leaving no stone unturned when it comes down to performance to make sure that we do the best for the trust and the trust does the best against the benchmark and its peer group. So I think we're doing the right things that way in terms of communication and getting the message out. That's something that we've invested quite a bit of resource in, and we with the new tools and social media and the internet, there are new ways of getting our message out as well. So that's something that will be a continual focus for us going forward. And then other than that, the marketplace does what it wants to do. We did have a soft period of performance about 5 years back that might still cause some overhang. But if we keep this up, the discount should theoretically narrow, and we can just make sure that we focus on doing the right things by the trust.
Make it look like an attractive entry point. Well, I'm afraid that's all we've got time for, but that was really, really interesting. Thank you so much for your time. I really appreciate it.